Welcome to CFTC Talks. I'm your host, Andy Bush. Hey, please subscribe to the podcast by going to iTunes and searching for CFTC Talks. Or you can listen to the podcast by going on our website, cftc.gov, and click on the podcast button. Just a quick reminder, there's a disclaimer at the end of the show that's important for you to hear. This week, we return to the markets and the market narrative. Remember, our goal is to learn about market dynamics, liquidity, and fragmentation. Hey, we're also trying to understand what's driving the markets. And to do that, we need to understand this crazy thing called the market narrative that is currently driving values. You know, the big themes that market participants focus on, from economics to earnings to government policy. To this end, we begin the information gathering by turning to someone who's been involved in the markets for over 40 years. Jack Ablin is the Chief Investment Officer for BMO Private Bank in Chicago. As head of the macro strategy, Jack chairs the asset allocation, mutual fund reoptimization, and Harris Screen stock selection committees, and is responsible for establishing investment policy and strategy within the BMO Private Bank throughout the U.S. Mr. Ablin is also the author of Reading Minds and Markets. He's a contributor for CNBC, Bloomberg TV, Wall Street Journal, and Barron's, and he's served as a professor of finance at Boston University. Jack, welcome to CFTC Talks.
Thanks, Andy. Glad to be here.
Hey, recently we had on the show the chairman of the Senate Agricultural Committee, Senator Pat Roberts from Kansas. And early in his career, he was a newspaper reporter in Arizona. And I noticed you were a money and markets correspondent for NBC in Jacksonville, Florida for 5 years early in your career. What did you learn from that experience, and how did it help shape your views on the market?
Yeah, I think when it comes to individuals, most people don't care about every tick and plus that goes on in the markets.
What?
I think what they care about is what it really means to them, and what a lot of the noise on Wall Street means to them can be translated to mortgage rates. It can be translated to pump prices. It can be translated to 401ks. But beside that, I'm not sure most Americans care about the turnaround plan at GE, for example.
Right. And so as a correspondent, that really came and was apparent to you as you were doing the news.
Yeah, and I think it's really just a matter of relevance, So, you have to report the news, but you have to explain it in a way that's relevant to the people watching, or they'll just turn the channel.
Yeah, that makes a lot of sense. Well, let's jump to the present for the markets, and there's a lot of fun and unusual things happening right now. So let's talk about, two of the most challenging first. One is low volatility, and the other one has been a 20% increase in stocks over the last year. Let's start with low volatility. What's your view here? Why has this been happening?
Yeah, I think that low volatility in the stock market, in many respects, it's just a reflection of low volatility of economic data. We've had not only the third longest recovery on record, but it's been the shallowest, and it's been the most steady. And so when your economic data comes in, metronomically and pretty much precisely, the equity market tends to respond to that. And so very low volatility of economic data, very low volatility of stock prices.
Yeah, that makes a lot of sense. And I know we're starting to get a little bit more volatility. The stocks have been selling off a little bit, which had been unusual. But let's talk about the top three reasons that you think for the 20% rally since last year.
Yeah, I think certainly number one is just a reaction to an administration and a Congress that's business friendly. So this has been a 180-degree turnaround in assumptions on regulations and the like. Keep in mind that even though President Trump and company haven't been able to accomplish anything legislatively, the environment has changed. And so I think that's what equity investors are responding to. The next is to some degree, to a large degree, it's central bank policy, because now virtually all central banks are getting into the act of quantitative easing. You remember, it was really a pretty courageous Ben Bernanke who went out on a limb and tried an experimental policy. And I remember myself back in 2009 flapping my arms thinking that this was going to create a lot of inflation. And, and for all intents and purposes, it really hasn't. And it's actually worked out. And of course, the European Central Bank, Bank of Japan, Swiss Bank, others all over the world have kind of jumped on that bandwagon, and that's helped propel stocks. And then the third reason I would say is largely income inequality. I mean, the fact is that more and more income gravitates to the wealthiest families in the country, and generally, that next $1,000 that goes into the checking account of a wealthy family tends to get saved or invested, whereas that $1,000 that perhaps would have gone to a middle income or lower income family would have been spent. And so as a result of that, we're seeing a lower trajectory of economic growth, because spending, accounts for most of economic activity, and a huge decline in interest rates and stock market values, because that $1,000 is now going into the brokerage account.
Yeah, it's interesting. Well, you brought up policy, so U.S. domestic policy. So tell me, how are the markets looking at tax reform? Because this is blasted all over the media. It's really getting white hot right now. How are the markets looking at this thing?
Yeah, in general, I think the market participants are still skeptical. A couple of barometers I look at, but probably my favorite one is small cap stocks versus large cap stocks.
Right.
Small cap, the Russell 2000 has an effective tax rate of around 32%. The effective tax rate of the S&P 500 is 26%. And so arguably, if we level the playing field at 20, small caps should do better.
Right.
And in fact, right after the election, they did. They surged between November and December. But since that time, they've really unwound to a point where they actually went below that election day level on a relationship basis. Mm-hmm. And now they've come back, but they've only come back about a third. So if you argue that election day was a 0% chance of tax reform, and first or second week of December at that peak was 100% chance of tax reform, then I would argue that investors are looking at the possibility of tax reform at around 33 or so percent.
Interesting. I hadn't looked at it that way, so that makes a lot of sense. If the effective rate for the smaller companies, and they're paying a higher rate, if they get that 12% cut down to 20%, you'd think they'd have outside, they would benefit the most, right? So that makes a lot of sense. Well, are there any other winners and losers that you're looking at right now? I mean, I know that tax reform is kind of all over the place right now, but we're starting to get some of the formation, some of the things in there on the international side, and also with full expensing. Who is that going to benefit?
Sure. So I think that, it's funny. I think it's a double-edged sword with the technology companies, for example. I think they would benefit from, capital investment. So they themselves would benefit from the tax break, but also perhaps their selling of software and other capital expenditure items that their customers would buy could boost their top line near term. The only problem is they've also been one of the largest beneficiaries of the kind of the global tax arbitrage that's been going on. And, companies like Apple, for example, I would bet, I don't know the exact number, but I would bet their effective tax rates, high single digits.
Interesting. Wow, that surprises me. I guess when you look at things, you know that these companies, and this is what they're supposed to do for their shareholders, is reduce their tax burden as much as possible. But and take advantage of all the quirks in the tax code. But because of that, when these guys earn profits overseas, it's like I think there's something between $2.5 to $2.7 trillion that's not ever going to come back to the United States in unrepatriated profits. And I think what gets me excited about it, and maybe you can correct me if I'm wrong about that, but if that creates an investable pool of capital, and then you get full expensing where you can write off a plant and equipment in the year that you do it, you actually have an incentive to do something with that money. And I don't know if that comes into any of the calculations when you're looking at GDP growth.
Yeah, I haven't really forecast GDP growth. What I have done, though, is looked at the impact of a 20% flat tax rate on S&P profit growth. Okay. And from that perspective, it looks like we would get about $10 a share. Wow. Pop, obviously one-time pop, right? In EPS growth in the S&P. Well, given that S&P earnings is around 130, 135, somewhere in there, that would argue then for probably an 8.5% to perhaps a 10% price pop in response to tax reform. Well, I've already told you that about a third of it is priced in, so perhaps we would get, maybe 5, 6, 7% pop out of the tax reform package. On the other hand, if it disappoints, we don't get the package, we could see 3, 4, 5% pullback. Okay, I was just going to ask you that. Like, if we didn't get it, then obviously, if it's a third of the 10th, then that makes a lot of sense. That you would get somewhere between 3 to 5%. Yeah, I think there would be some blowback too. I mean, there's a fair amount of credibility riding on this too. Right. I also think that based on the comments that we're hearing from Treasury Secretary Mnuchin, it seems like his job's riding on it. My sense is if this doesn't get passed by year end, he's probably going to be yanked out of that position. Well,
and I think there's a lot of other people in government that might be in the same position. I've seen some comments from some of the Republicans, and when they're talking to their constituents, they're like, "We really want you to get this done, or else."
But and that's notwithstanding the entire Republican Congress. If they can't deliver any legislation when they control 3 branches, two branches of government. It's arguable if they control that third one, but certainly the legislative process. I think their jobs are at stake. And I think they realize it. So there is a huge political motivation to get something done, and that's why I think now we're throwing, the individual mandate into the mix just to try to placate as many participants as possible.
Interesting. Well, one of the things they are moving forward on is of course regulatory reform, and that started January 1st almost with some of the executive orders from President Trump. How do you think the markets are looking at that?
Yeah, I think that's a really favorable trend. I think there are really, pluses and minuses when it comes to presidential authority. As you just mentioned, the president does have a fair amount of leeway in not only rolling back regulations, but also perhaps instructing his cabinet organizations to whether or not to enforce regulations. So he doesn't even have to necessarily pull the regulation back if he's instructing, the EPA, for example, or the OCC or whatever to just not enforce. So I think that is an effective rollback. On the other hand, the president also has a fair amount of autonomy when it comes to trade. And that's a concern because I can't think of any economist that has stood up and said if we rip up NAFTA, roll back trade and sort of look closer to home, that's ultimately better for our economy.
Well, since the president was just there, what are the major themes you see happening from an investment point in China? I mean, I know you just brought up trade, which is why I'm asking the question about China, but they're our largest trade partner. So I'm just curious, from an investment standpoint, what do you see from China that you're interested in?
Sure. China's a fascinating culture because it is a, central control and command, sort of a capitalist environment. I mean, they're certainly fully engaged in the global supply chain, and yet Beijing has ultimate authority on, moving pieces around the board, at least within their country. And so when they embark on an initiative, I take notice. Obviously, the infrastructure that we saw over the last couple decades really moved a lot of markets, notwithstanding, of course, commodities, but certainly a lot of other markets as well. Now, they've shifted their attention into alternative energy, and I would say certainly thanks to the work that the Chinese have done in this regard, the cost of generating solar power is down 80%. That's not something that we've done, unfortunately, in this country. That's really clearly the work that they've done. So where do we go next? It looks like they're pushing very hard into electric vehicles. In fact, notwithstanding Tesla and everybody else, China sells way more electric vehicles than anywhere. They've produced and sold more than 500,000 electric vehicles over the last year.
Wow.
And they're also fixated on battery power now, not surprised. So when you have a strategic initiative of a country like that, who isn't concerned about profits, and they're going to push in this direction, what does that mean for those of us who are concerned about profits? Well, it means that, if you're competing against them, if you're a Tesla, for example, and you're competing against the Chinese, that could be problematic, but it also means that if you've got the resources, if you've got the commodities that battery requires, like lithium or like cobalt or copper, that should be you should see some increased demand. So there are a lot of elements there, and I think that's a trend that looks like it's going to push forward, especially since it's really a strategic initiative of the country and not necessarily just some profit endeavor.
Right. Well, you brought up an aspect of technology, so let's spend a little time in that space here. Tech companies seem to be driving profit growth in the United States with FANGs or FAA, MGS, whatever you want to do, that acronym. Could you break it down for us? Why is this occurring? Why are these the biggest companies, and why are they generating so much profit?
Sure. I think they're the biggest companies largely because the regulators allowed them to become the biggest companies. And so, companies like Facebook, didn't invent Instagram and didn't invent the Messenger. They went out and bought it. I mean, these were threats and competitors that they went out and purchased and then bolted onto their offering, right? Which creates a dominance. Now, there's good and bad to that, I suppose. It's good globally. We want to have the largest, most competitive companies put forward that can compete on the global stage, and that works well. On the other hand, if they dominate our industries, and many companies do dominate the industries they're in nowadays, more so than they did 30 years ago, what that means is their incentive to innovate is low. I mean, they can pretty much just clip that coupon and continue forward. And as a result, one of the reasons why perhaps our productivity is as low as it is, I mean, the lowest it's been in decades, is because we may have a lot of fat, dumb, and happy companies sitting at the top of their food chain.
Interesting. I hadn't thought about it that way, but yeah, I mean, once they get to a certain size, it doesn't seem like Amazon's doing that, but that is a great point. And one of the things that fascinates me about technology, obviously, is there's one component that's out there that I think is really interesting for the financial markets as well, and that's, of course, distributed ledger technology, or DLT, or blockchain. This tech has really led the development of cryptocurrencies like Bitcoin and Ethereum. How are the markets viewing these, Jack, and where do you think this thing's going?
It's a great question and something that really puzzles me. I have a ton of respect for the underlying architecture. distributed ledger technology is great because ultimately currency requires faith. And having an architecture like that where you have multiple checks and balances really preempts the possibility of counterfeiting and just, having the thing at least, all of a sudden have either fewer currency or fewer coins or more coins than you expect.
Right.
So in terms of a value, in terms of the denominator of that equation, it's pretty solid. But on the other hand, because it lends itself to money laundering and to underworld's, unaccounted for value, border crossing and all that, it doesn't deserve a seat necessarily at the table of a lot of the large financial institutions, and we're seeing that now. So I do think that there's a use for it. I mean, when you see so much turmoil in so many countries, or
right,
when Prime Minister Modi demonetized the currency in India, I can see all of these motivating shifts to put your wealth online, and then if you have to move countries, well, just log in from the other country and your bitcoins are wherever they just follow you.
Right.
So I think that there's when the more economic or really more political uncertainty going on, then the demand for Bitcoin and other cryptocurrencies will likely rise.
Interesting. All right, one last question before I let you go. And I know I want you to, this is tough, you got to peer into your crystal ball a little bit, but what do you see are the major themes that are developing for the markets out in 2018? What are you going to keep your eye on?
Yeah, so I think that, certainly valuation is an issue. I mean, if you were to just line the total return of the market against the cumulative growth in dividends and earnings, you're going to find, even right now, looking out, assuming we get the next 4 quarters of earnings that analysts are anticipating, there's still a gap, a 19% gap. So that's problematic. That said, there has been a gap for a while. So, I'm not expecting necessarily that Minsky moment when everyone realizes the market is overvalued and then boom, it drops. On the other hand, we are reaching probably toward the end of an economic cycle. As we said, slow and steady, but eventually when you run out of either capacity for production or capacity on the labor side, prices will have to rise. And eventually, if interest rates rise faster than profits, that's going to turn things around. So I would expect we will start to see something between now and the middle of 2018 that would likely prompt a rise in interest rates faster than profit growth, and that could then prompt us and other investors to perhaps reduce our risk profile.
Interesting. All right, Jack Ablin, CIO at BMO Private Bank. Thanks for coming on the show today.
Thanks, Andy. It was a pleasure.
By the way, if you want to learn more about virtual currencies, you can listen to episode 14 on CFTC Talks with Daniel Gorfine. And you can get the CFTC Virtual Currency Primer on our website. As well, there's a Chicago Federal Reserve research piece called Blockchain and Financial Market Innovation you may want to check out to get a bigger picture perspective. That's our show this week. Remember, if you want to hear more podcasts, you can go to our website, cftc.gov, and click on the podcast button. Or you can find us on iTunes by searching for CFTC Talks on your podcast app. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guest. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.